Japan's central bank has left its main interest rate unchanged. That wasn't too much of a surprise, but it defied market expectations of a major reduction in its economic stimulus program. Instead, it said it would continue to buy more than $700 billion worth of bonds a year. Dr. Seijiro Takeshita is the dean at the School of Management and Information at the University of Shizuoka. He says the Bank of Japan's low interest rate policy might not be sustainable in the long run.
Well, I think they did a pretty good job in soothing down the market. You can see this from the reaction, for example, from the bond futures prices. They made it very clear that they will sustain this current low level of interest rate policy until fiscal year 2020, and partly because they've announced their estimate for CPI to be lowered from 1.8 to 1.6 for fiscal year 2020, which is very rare. They don't go that far in making that estimate. But I think Bank of Japan did what we call the forward guidance, which is giving the indication of the market of where their strategies would be in the future. So it's also a bit of a commitment side as well. So I think the market was soothed down. In that sense, I think they did a pretty good job in, I would say, the announcement effect. I think they need to be flexible. Firstly, they don't have a lot of room in their pocket. They pretend that they have a deep pocket. They don't. Secondly, I think what you're starting to see is the consequences or the negative side effect of this prolongment of this long-term continuation of this low interest rate. So obviously, you're seeing the banks that are screaming, and also the Japanese companies aren't really reacting to lowered rates to start investing, in spite of the fact that they're flourishing with profit. And yes, we have a good forecast for the capital expenditure next year. But we also know that there's a lot of external ambiguity factors that are rising quite rapidly, particularly from the protectionism in the United States, and also some of the turmoil, such as higher oil prices, that could be putting a jeopardy to the Japanese investment plans. Well, I think there's an indication that there is a possible, I think, a rate rise to come, but all the government will be trying to sustain their, low rate policy. They would like to perpetuate this move. But then again, I think many of the central government, central banks, including the Bank of Japan, made its move while they can. Again, they're seeing a lot of external factors that are rising, which could jeopardize their, possible future options and operations. So, as for Bank of Japan, they wanted to make clear to the market participant that they would be ready to be flexible enough to cope with a possible turmoil that are likely to come, not only from the external factors, but the 2019 problem that we're likely to have, which is basically a downturn in the economy after we hit the boom on Tokyo Olympics related demand in 2020. The corporations are certainly flourishing on back of the weakening of the yen and global demand. And they currently have a very strong plan of continuing to invest, which is obviously good news. And obviously the banks are flourishing right now, especially the mega banks are flourishing with income of cash position. But that said, we all know that they're not really, this is not necessarily a result only from the economic activity, but due to the fact that Japanese companies are very conservative and they want to sustain cash at hand rather than just investing it. So I think we have to look at from the fact that, the Japanese corporations tend to be extremely or excessively conservative in that sense. And the banks, especially the mega banks, are flourishing right now. But they're still suffering from low interest rates. And I think there's also a very big side effect of this, prolongment of this low interest policy, which is really starting to hurt the Japanese regional banks. And that is another headache that Bank of Japan would have to face in the very near future.